Hello and welcome to another installment of InsMax Insurance Brokerage Thursday webinar series. I'm Larry Carrasco. I want to remind you that these webinars are hosted every other Thursday at 1 p.m. Eastern Time, and we thank you very much for attending today. Our short presentation will cover what we call a concentrated stock alternative and asset allocation story. But before we get started, I'd like to provide a little information about who InsMax is and what we do. We share ideas and concepts that solve real-life problems. We work for our advisors. We have over 20 years experience in the brokerage business, and we work with more than 30 of the major insurance companies. We provide the training and customer-approved marketing content so you can approach your clients. We handle your contracting and licensing when your clients want to implement a plan. We also provide pre-underwriting information to uncover and address your client's specific impairments and determine the best insurance company for their risk. We also give our advisors all the forms needed to complete the application, and we review the completed forms for errors and omissions. We handle the entire underwriting process from application to submission, including scheduling the exams, obtaining medical records, and negotiating better offers with the carriers. In short, we are a full-service brokerage company that you can trust. We like to say we're the experts, so you don't have to be. Now let's get into today's topic. Concentrated asset allocation. So what is a concentrated stock or a concentrated asset allocation position? Quite simply, it's an overweighting of value in a particular stock or sector. Many clients have amassed significant wealth from a particular position, perhaps from an inheritance or the sale of a business where stock was used as part of the purchase or acquisition. Others amass a stock via bonus or purchase plan. And some companies even have employee stock ownership plans or ESOPs that allow employees to own a part of the company that they work for and purchase that stock through a qualified plan deductibly. These situations often result in high concentration of assets in a single investment. However, the very asset responsible for creating significant wealth may eventually become the biggest risk to a client's financial peace of mind. But irrespective of the source, the decision to diversify can be an emotional one for clients. They and their families can become attached to a stock so much that they have intense loyalty to it over the years, primarily because the stock has done well and offered them good performance or provides strong dividend income. Other clients don't want to sell a stock because they're concerned about how to avoid a potentially large tax bill, yet still diversify. Others say, I intend to leave this to my kids and even my grandkids because it's treated them so well during their lifetime. So while it's tempted to get caught up in the performance of your company's stock, the benefits of reducing concentrated risks are very straightforward. Reduced forward-looking portfolio risk and increased portfolio efficiency. As we all know, good things don't last forever, even with these particular stocks that have treated you well. Markets can be very volatile, and as we've seen just in this last year, things go up and things go down. And clients may get emotional and sell at the wrong time. Some companies can even begin to lose their value over time by failing to either innovate or adopt new methods or to produce new products to compete. Heck, even over the last 2 decades alone, we've watched many blue chip stocks go bankrupt, sometimes abruptly, and always at the peril of overly concentrated investors. Now, these aren't little known companies, but household names like Delta Airlines, United Airlines, Bethlehem Steel, Kmart. Does anybody remember Enron or Lehman Brothers, Texaco, Circuit City, and many, many more? Very few folks predict that a fast-growing company or household name will meet its demise. However, it happens more than many of us would care to admit. So that's why it's vital for your clients to evaluate a stock concentration, especially now when markets are positive and sentiment is bullish. Working with an advisor who maintains an objective view can help investors see past their emotional attachment to certain stocks so they can develop a plan to diversify their portfolios and protect their wealth. But diversification doesn't always guarantee a gain or protect against losses, but it can potentially lower portfolio risk. One suggestion might be to integrate life insurance as a separate asset class within the portfolio. Life insurance can offer increased predictability on the value of your money through the death benefit. That death benefit is non-correlated to the stock market, and its internal rate of return is tied directly to a life expectancy of the client, not the stock market. Life insurance can potentially reduce exposure to price volatility in a stock, and the tax advantages that life insurance offers could actually help leave more money to your beneficiaries. But let's talk about maybe getting the best of both worlds. That is, let's add some diversification, yet maintain a significant position in this particular concentration. One might propose this allocation design. So let's suggest we sell a portion of the stock, not all of it, and we're going to use that portion to acquire a policy for legacy planning that also provides some certainty, a good rate of return on the benefit. But how do we get a client to let go of that particular asset that they've become so fond of? Well, one might propose this allocation design. Mr. Client, let's sell a portion of the stock to acquire a policy for legacy planning that provides some certainty, again, a good rate of return. And maybe we can ask this question. Mr. Client, how high would this particular stock have to rise for you to sell it and move on, or sell a portion of it and move on? Sit back and wait for the question to reveal itself, and you might be surprised at what you hear. For today's discussion, I assume that a client owns $1 million of Johnson & Johnson, a blue chip stock that's been around for decades. They may have originally bought it at $90 a share, maybe 5 years ago, but it's currently trading near $150 a share. And our design calls for selling $300,000 of this stock and using the after-tax proceeds, which are about $269,000, to provide approximately $1 million of tax-free death benefit for legacy planning. Through this, we're also going to demonstrate strong internal returns on the death benefit that should integrate into the client's overall performance goals. So let's look at the plan. This page demonstrates selling 2,069 shares of J&J, or this red section of the big pie here. That's $1 million. We're going to sell it at the current price of $145, which, as I mentioned in the previous slide, would net the family about $269,000 that could be used for a single premium life policy, providing $1,002,654 for the family, maybe through the use of an insurance trust. In our example, we point out to the client that the life insurance leverage is an incredible tool to consider. What we've effectively done is guarantee the family that the stock would have to increase by $503 to $648 a share in this blue box in order to equal the life insurance benefit. So what we've effectively done is guarantee the current value, meaning the entire position, which is right at $1 million right now, guarantee that to the next generation. and left $700,000 of the stock untouched. Now, this might give the client some peace of mind in the event there's volatility or other factors that lower the share price of this stock. But there's more. Here we can compare the current position in red, which would be potentially all includable in the client's estate for tax purposes at death, versus the remaining stock value in gray, $700K, plus the $1 million death benefit from the policy. The death benefit from the life policy will pass income tax free to the beneficiaries and potentially estate tax free if it's owned outside of the estate. As a result, the legacy value of the portfolio has increased significantly by nearly $700,000 versus where it was the day before this transaction was consummated. But let's consider the allocation from a cash point of view, an investment point of view. The internal rates of return at death, illustrated here on the column called IRR on death benefit, are quite high. In fact, if death occurs at or near life expectancy, these are extremely significant. But as the client gets older, in addition to having the death benefit, we can also suggest that using the policy surrender value as an exit strategy, if they didn't want to keep the life insurance, the family could achieve a modest rate of return on the cash value itself besides the death benefit. So let's consider this allocation and some of the other things that we have available to us when we're talking with the folks here at INSMAX. We want you to recognize that there are resources for you and they're just waiting to be utilized. As we continue to mention in all of our webinars, these include advanced planning attorneys and design specialists, both at the carriers and here at INSMAX, who are just waiting to work with you to help you with your cases. We can help you create client-approved presentations and take you through all the concepts. All we really want is to help you, and we appreciate a phone call. So now we'd like to open it up for questions for those that have them. In a moment, Greg Leahy will unmute all of the lines. But before he does, I just want to thank you for joining us today. I urge you to give us a call about today's presentation. And I want you to remember that in 2 weeks or on December 3rd at 1 p.m., we will present Premium Financing 101. This is a basic presentation that includes what is good about premium finance, who might be a good candidate, pitfalls to consider, and also requirements from the carriers. So before we say goodbye, again, I want to thank you. I look forward to seeing you next week. Just remember, INSMAX is here for you. We take the commodity out of brokerage. And with that, Greg, if it's okay, I'd like you to open up the lines for questions.
Okay, so I have unmuted the lines. You'll still need to, as a participant, you have to unmute yourself. I can send everyone a request here. Anybody have any questions?